Just can we call this a rebounding market when sales are stagnating?
Hi, Lisa. Yeah, it's a good question, and we've been describing the U.S. housing market as a tale of two markets. On one hand, you have the resale market where volumes are down more than 30% still from their peak due to greater affordability challenges and a lack of inventory. On the other hand, you've got the new home market, which has been the beneficiary of that, as that lack of inventory we spoke of is actually funneling demand in towards the builders. And builders are also able to leverage their financing arms. So they've been buying down rates. So when you see someone in the resale market paying, 7.5, someone coming into the new home market is looking at 5 to 5.5. But that being said, the broader housing market, as you said, I wouldn't necessarily call it a rebound. I mean, if you look at total sales in the existing home market, which is the biggest part of the housing market and the largest source of competition for the builders, we're at about a rate of 4 million. So we're still down a long ways. I think the thing to point out is we have a situation where volumes are being depressed, but home prices are stabilizing because of that inventory situation.
Just want to pick up on what you're saying, Drew, and sort of push forward to later today when we get the Toll Brothers results. You said that a lot of these home builders are offering rates of 5 and 5.5% to extend their own mortgages to buyers of their homes. Is this essentially the effective rate in the new home sales market, since the other existing homes aren't really moving? Is this basically what's happening, that no one's paying that 7.1235% yield on the 30-year mortgage? No one's actually paying that who's coming into the market right now.
Yeah, so what we've heard from the builders is that a majority of their buyers are leveraging their national rate buy down programs. And you're right, they're not paying what we're seeing quoted at the market level. That being said, if you look at where rates are now, we checked before we came on this morning, we're up 7.5%. I think the last time we talked last week, we were at 7.25, and we're up more than 100 basis points since the beginning of April. So while people coming into the new home market are getting a lower rate, that rate too is going to go higher. And I think the concern for people investing in the home building space is going to be at what point the buyers start to balk and at what point the builders have to kind of lever back up on their use of incentives to keep traffic moving. Because we saw from the latest data from the NAHB that when rates rose, traffic fell pretty sharply. So we think that if rates do sustain at these levels, we're going to see that use of sales incentives come back a little more forcefully.
Just real quick here before we get to our next guest, because this really is the topic of the morning as we see yields go to the highs going back 16 years. How long are the lags? Are we starting to see yields bleed into the housing market in a more concrete way that give you conviction that we're just seeing the start of it rather than already having seen the worst of it?
We've seen a lot of pain in the housing market, particularly in the second half of last year. But we haven't seen the recovery in the existing home market, and that has to do with the fact that rates are so elevated. We have seen a disproportionate benefit, as we mentioned, in the new home market. But broadly speaking, the fact that rates are still elevated doesn't give consumers a whole lot of confidence. And the fact that, we could be heading even higher from here, from 7.5 closer to 8. I think that continues to pressure sales volumes through the remainder of this year and into next year.